Okay, good morning, everyone. We'll go ahead and get started, and I will keep an eye on the waiting room here and let people in. Hopefully, we'll get a few more joining us, but welcome to our spring meeting of the Investment and Treasury Management Affinity Group for Maryland GFOA. My name is Rob Burke. I am the Affinity Group Chair for the Investment and Treasury Management Affinity. I am the CFO for Carroll County Public Schools and a past president of Maryland GFOA in 2023. Really looking forward to our discussion here this morning. We've got the topic advanced liquidity and treasury management, and pleased to be joined by our speakers. We'll get to them here soon. Chris Iorio and Michael Abbott from representing cashVest by Three+One. Um, cashVest is a new sponsor to Maryland GFOA. Pleased to have them as a silver partner this year, and recently was also a quarterly conference sponsor where I got to meet these gentlemen and strike up a conversation, get to know a little more about their product and their offerings. And so I thought they would be a good fit for our affinity group here this morning. We will leave a little time as we wrap up for Q&A, but I think we'll have a group here where if anybody wants to jump in, just ask that you use the raise hand or even type in the chat, and we'll keep an eye on that. So with that, I'll turn it over to Chris and Mike, ask you all to share your background a little bit, and then we'll jump into our presentation for today.
Thank you, Rob. Pleasure to be here today. Like you mentioned, my name is Mike Abbott from Three+One. I've been with the company about 5 years now. In that time, I've worked with many entities across the country, helping them with this exact topic, advanced liquidity and treasury management. So I've seen a lot and really learned that every entity is very different. So excited to kind of share an overview of some of the best practices available on this topic. I'll let Chris introduce himself.
Yeah, hi, I'm Chris Iorio. I'm Three+One's business development officer who leads our efforts across the state of Maryland. Unlike Mike, have only been with the company for 5 months, so I'm still, learning as I go a little bit. My previous background, I was working and not parallel, but I was working with public safety. So I had a little bit of experience of working with public sector entities, but obviously not as much as on the finance and liquidity side. So, opportunities like going to the Maryland GFOA Winter Conference is really exciting for me to get to make connections with people like Rob and kind of learn a little bit more about your world and understand, what type of objectives or situation you guys are dealing with and understanding how cashVest might be able to help alleviate some of those. So really excited to continue making those connections and having those conversations across Maryland.
Okay, we will get started. And like Rob mentioned, if anyone has any questions as I'm going through the presentation, please feel free to jump in. I prefer it to be a little bit more collaborative. So, all right. Okay, so again, I want to kind of touch on a high-level overview of the topic advanced liquidity and treasury management. There's a lot of pieces that go into it. There's a lot of just best practices to think about. So I want to start with your investment policy. I think it's important to start here and talk about the framework before kind of diving into those day-to-day practices. So why is investment policy important? Many reasons, of course. Number one of those reasons is to protect public funds. As your job as a public finance official, number one importance is making sure you, of course, never lose principal and are a good steward of those taxpayer funds. So your investment policy really establishes guidelines and kind of the framework for you to stay within as you're looking to invest and from just a general cash management standpoint. It also ensures more continuity during times of staff turnover. right now we are in a time of more turnover than we've ever seen before in the public sector. We're also in a time where it's hard to find new employees to join your team on the finance side. So it's really important that when you do have, a new employee come in, or if say you're someone that's going to be retiring soon or moving on to, a different entity or different position, you have this policy in place so that whoever's coming in and filling your role is able to kind of hit the ground running and really understand the best practices that your entity goes through when it comes to investing and cash management. Even more importantly, I'd say is you could see this third one here is a bit highlighted, and it's supporting audit and oversight. Of course, if you have any questions from auditors, it's a lot easier to show them your policy, your board approved policy, and that usually answers a lot of questions as it comes to your best practices with um, cash management and investing. So it helps from that regulatory standpoint. If you have any questions from auditors or any stakeholders or taxpayers, you can easily point to that board approved policy. And then, of course, on the risk management side of things, the policy is really designed not necessarily to always think about the worst case scenario, but to help you weather those storms when they do come up. Um, so I know in Maryland, what we see pretty often is limits on the type of investment, or how much you can have in a single type of investment, or the amount of cash you can have with a single bank or issuer. So those types of things kind of help you reduce the amount of stress and risk you're taking on. Okay. So I always like to start the topic of cash and liquidity management with the three pillars or objectives of public funds investing. So we have safety, liquidity, and yield. And I'm sure many of you have heard this, whether it be in a policy or from GFOA in the past. But what I think is really important about these three pillars is the order that they go in here: safety, liquidity, and then yield. Um, First of all, safety. Again, as a public finance official, your number one job is to ensure the safety of public funds. I always say number one job of a public finance official is to keep your name out of the headlines. So, that starts with ensuring that you're never losing principal of your funds and that you have sufficient safety before we talk about the next two things. Second one, liquidity is also extremely important. Making sure you have sufficient liquidity so that you, at the very least, can make payroll and AP. You never want to run into the situation where you don't have sufficient liquidity or you're waiting for funds to move back to your bank on payroll day. So, of course, after safety, liquidity is kind of a close second in terms of importance. Third is yield. And I'd say it's a distant third, but it's also extremely important that you're maximizing the value of taxpayer dollars and getting the most value. And there's many ways to do that. There's benchmarking, working with your banking and financial institutions to ensure you're getting the best return on your cash. And we'll spend a lot of time today kind of going through the best practices for that and where you can look for enhancements on that side of things. So again, safety, liquidity, and yield are always the three things you should be referring back to when we're talking about your cash management approach and this advanced liquidity management topic. And again, in this order, it is extremely important. So when I was going through and putting together this presentation initially, I didn't have this slide in, but I was speaking to a group of finance officials about a month and a half ago, and this slide came up, and I got some feedback that it was really important and really sparked a lot of conversation that they really hadn't thought about in the past. And it's centered around your business continuity plan or disaster recovery plan, as some entities call it. And it's really just another way to think about worst case scenario. Because as we don't necessarily plan for the worst case scenario, it's always good to have that in the back of your mind in case one of those situations arises. Yeah. There's an entity I work with out in Montana, and they had one of these issues conveniently on payroll day, of all possible days for it to happen. Their main banking institution, their website went down for about 30 minutes, which forced a delay in payroll. As I'm sure all of getting payroll out late, even if it's just 30 minutes, is, you know, a really big event. And it can cause a lot of stress, on the people, of course, you're paying, but more importantly, on your office and everything you have to deal with that comes with that. So in their situation, it was only a half hour late, but they spent 3 days contacting all of the local banks and credit unions that their employees banked with and trying to waive those overdraft fees. Because as I'm sure you know, with personal finances, a lot of people will have automatic transfers on payroll day sent out to, say, pay their mortgage or pay any type of bill or just move money to their savings. So these caused a lot of overdraft scenarios, and they spent lots of time and manpower trying to get those fees refunded to all of their employees. But not only that, but there's also the more important issue of people didn't see money in their accounts when they woke up that morning. So obviously not a great situation, and it really made me think about all the entities that I work with across the country and all of their disaster recovery plans, and it really made me pose the question of if you have something like this, maybe it's not on payroll day, but if you have something like this come up where, say, the bank website's down, or you have someone that normally approves your payments that got really ill and couldn't come into work that day. It could be as simple as that. What is your disaster recovery plan? And of course, are you testing it? So that's another piece. Um, I'm not necessarily saying go out and open a secondary banking relationship just on the off chance that something like this happens, but start to think about if there is an issue with, say, your main account where you send out checks, what is your backup plan in a case that something goes wrong there? It's important that you test that periodically too. And again, I'm not saying you switch payroll to have it go out from another bank for, 1 week a year just to test it. But be in regular contact with that secondary banking institution. Send them your payroll file just to make sure that if something goes wrong, they're able to pick up the slack and um, help you if a situation like that arises. So I always like to start with that just as something to think about. Another piece on the whole safety and liquidity side of things that I think is really applicable is rating agencies and how they view liquidity data. Because I think this really just shows the importance of taking a more proactive approach and having data to kind of back up all of your decisions. So, three rating agencies, S&P, Fitch, and Moody's, um, part of their municipal credit ratings include, you see down here, liquidity at 10%. And 10% doesn't necessarily seem like a lot, but if you're trying to get the best credit rating possible for your municipality or your entity, it's important that you have data to back this up. And on top of that, auditors also like to see liquidity data because it really shows that you're taking a more proactive and you have an effective cash management approach. So that's just something to think about. I think it's really important to um, have this data just in your back pocket. So if you have any questions from stakeholders, you can point that all of your decisions are backed by data and real world examples. So I got 4 steps here that I kind of want to talk through, and there's many different points I can go into here, but really 4 main steps I want to start with that can help you maximize earnings. So that third pillar, maximizing the yield on your cash. The first of which is really just think about all of your cash as an asset. A point of feedback that I hear a lot from entities is, there's these dollars here that aren't allowed to legally earn interest, or I'm worried about arbitrage. There's only so much interest I can earn on these borrowed proceeds. And all those are certainly valid concerns. But what we could also say is there is always a way for you to get value on every dollar. A lot of banks that charge fees will offer an earnings credit rate, which I'll talk a little bit about towards the end, that allows you the opportunity to offset those bank fees without earning interest. So maybe that's another way that you can earn value on dollars if, say, you're not allowed to earn interest or you're worried about arbitrage on your funds. Another important point is making a short-term forecast. On this slide here, it says at least on a quarterly basis, monthly is more preferable. Whatever works best for your process to help you really understand, the your future forecasting and what your cash position is anticipated to look like. 6 to 12 months has been considered best practice by GFOA standards. So I think it's really important just so you have a good idea of when your high and low cash periods are, and combine that with your knowledge of what this budget year looks like and anything that hasn't typically happened in the past, how that's going to affect your cash position moving forward. Next, it's really important to compare earnings that you can get across the market, whether it be comparing banks to bank or different investment options, whether it be a US Treasury or a government agency or even a bank CD. There's all sorts of different products available out there. So it's important that you're regularly going out to the market and just understanding what's being offered. And then finally, more on the banking side of things, looking at your bank fees. It's one thing to determine the value you're getting for the dollars you have on deposit at the bank. It's another thing to determine from your analysis or billing statements those fees that are being charged to your entity by the bank, and are you being charged an appropriate value? The banking world is becoming more and more sophisticated. There's more and more services coming out, particularly on the fraud side of things, which is great. And you should really be taking advantage of everything your bank has to offer. But there's also a competitive value for these services. So that's why it's important to go out and see what maybe other banks are charging clients for that same fee, or just understanding what other similar sized entities are paying for that fee at your current institution. So there's a lot of ways to benchmark bank fees that I'll dive into in a little bit here. But these are just a few of the first things that you should start thinking about when you're looking specifically to maximize your earnings. All right, so I think really important in this advanced liquidity management topic is understanding the time horizon of your funds. So what we're looking at here is some data that we provide to some of our entities, and really what this is a stress test. So it's looking at historical data, and it's essentially coming up with a worst case scenario based on what's happened historically to set kind of a baseline of the cash could be invested or be moved out of your bank to higher yielding accounts. So in this example, we have this entity in particular. They have, if we look on the left here at the bottom, $74.2 million that is available for up to 30 months. What that means is, in a worst case scenario, this entity could have $74.2 million locked in for 2.5 years, and it won't impact their liquidity. So that's extremely important, not necessarily as a strategy to say you should invest that amount for that long, but if this entity felt that there was a lot of value and they had a really good, offer, say from a bank or investment product out there at that 2 to 2.5 year range, they have about $74 million that they could put into that type of investment. So this is really helping you understand the liquidity aspect. And then within this framework, you can adjust your investment strategy based on market conditions. So there's all these different buckets here with various different durations. And I always like to say, the first dollar, say that the county had, is probably still sitting in an account somewhere. So when you look at it in this overall total cash basis, you're really able to get a good picture of all of those that base level of funds that are available there. If you look at level 5, and then as we work our way up with those shorter durations. It's also important to identify a solid cushion. So for this entity, it's $40 million, and that's cash that during some of those lower cash periods can likely be invested in the short term if you have a good handle on that forward-looking forecast and what your expenditures are supposed to be for these next few months. That's cash that could be invested, but during those higher cash or lower cash period times, that's cash that's probably best kept in a liquid account. And of course, we have working capital, cash that probably best at your bank or somewhere you can easily access the funds. So this is kind of the baseline to start within to really understand that longer time horizon of your cash. So a lot of the entities, when I first start working with them, they don't have a lot of cash invested. And I'm sure of the people on the call here today, there's a wide range of people that have a large percentage of their cash invested, some that maybe don't have any invested in a fixed term product. And I'll start mostly on those that don't have a lot of cash invested, but it kind of goes for everyone in every situation here. And I always encourage baby steps. Um, think of it like a staircase. You never want to jump from from the bottom up to the fourth step. You want to take it one step at a time, and take the more conservative approach. It goes the same for investing public funds. I work with some entities that they'll see that last page, those stress test results, and they'll jump all the way up to invest 150 million right away. And typically, what happens in those situations is once investments start maturing, they start to get a little bit overwhelmed with just the sheer amount of cash and activity going on. On the flip side, there's those entities that take that stair step approach and take it a little bit at a time. So you do 10 million here, figure out how you like that process, see an investment mature and get a feel for what that process looks like. And then you do another chunk and you kind of work your way up until you're comfortable with that larger amount. So always like that baby step approach, just so you're not stretching yourself too thin, especially in a time where finance offices are as lean as they've been before and everyone's experiencing times of short staffing. It's really important that you just take a more conservative approach and do what you're comfortable with first. I think this right here is just a really good example of that. This entity I was working with a few years back when they signed on with us back in early 2023. You can see all the way to the left here. Actually, I should explain the colors here. The purple is a fixed term investment. So a bank CD, US Treasury, a government agency, anything like that. Then you have in the blue high yielding liquid accounts. So maybe that's a money market account at your bank or a sweep account. In Maryland, we have the Maryland LGIP. That's a great high yielding liquid account. And then the orange, that's any cash that's lower yielding. A lot of times this is sitting, say, in a checking account at your bank, right? So this entity, when they started working with us in early 2023, they had, for context, two very small CDs that had been sitting there forever, and they really didn't know why they kept rolling them. So they didn't have much really experience with investing at that time. So they wanted to start small. So they made $1.5 million investment here just to get their feet wet, understand the process, and understand what it would feel like to have a little bit less cash sitting at their bank. So they started with that and then sat with it for a couple months and like, yep, we're comfortable with this. I don't feel stretched too thin. And then they did another $1 million investment and they're like, okay, I really understand this process. We've seen one investment mature and be reinvested. I'm comfortable with this. And then they made a bigger jump. They jumped up to $10 million total here. And for them, they got really comfortable with that process. And now, they're investing even more of their cash. So this is just a snapshot in time of that first year and all the progress they made. But I think this is just a good example of that baby step approach and just allowing yourself to get comfortable with the process and then getting a little bit more aggressive with the amount of cash you have invested. I mentioned before, kind of on the cash forecasting side of things, why that's so important. So the last model we looked at, that's that long-term approach to understanding the time horizon of your funds. And that's kind of step one. And step two is this cash flow forecasting. I'm sure many of you do some type of forecasting in your day-to-day process, but on top of that, it's important that you look at what happened historically. Using that historical data as a baseline and projecting out what's supposed to happen, and then using your current year budget, your current year expenses, and anything atypical, layering that in to really understand where there may be more potential to invest. So this chart shows this green line here that's at the top, just the forecast based on what's happened historically. The yellow line, that's a low, very conservative forecast. And then the purple, those are the year prior actual balances. So what I could say for this entity is they'd worked with us for a while. We had a lot of data. So their forecast was super conservative and accurate in this case. And that's why all three of these lines are very close together, because the model is really confident in that balance position. So what this entity did was they took this based on historical balances as a baseline. They combined that with some atypical spending they're going to have coming up these next 6 months. And it really gave them a good understanding of how much more cash they could invest, particularly during this higher cash period. Another thing I think is really important to note is that flat black line that you see that goes across. That's that long-term cash that they identified could be invested throughout the entire year. So they had significantly more cash at times that could be invested, and this forecast, balanced with their knowledge of future expenditures, really helped them maximize their liquidity position and invest a little bit more cash. So another thing that I think is really important when looking at this overall investment approach is laddering out investments. What I hear very commonly is that, if I have $50 million invested, that's $50 million that I can never touch. And if I go below that, I'm going to have an issue, which of course is a valid concern, but it becomes less of a concern when you have a more laddered approach. So the example I'm showing here shows this first week, they have about a little over $16 million maturing. And then about a week later, they've got another four. And then about a month later, they've got two and then 13 million. So they've got all of these decisions to reinvest funds every so often. And that allows them to, at those points in time, take a look at their cash and liquidity and figure out, can I reinvest this full amount? Or maybe expenses are a little bit higher than I had anticipated, and take a little bit off that matured investment, say $16 million here, for example. All right, maybe I take 5 million off, reinvest the other 11. So you're still staying invested, but you're adjusting for the lower cash position that you may not have anticipated. So having this laddered approach really allows you to have a more diligent liquidity position and come up with those decisions so that you can have more cash invested and really take advantage of those higher yields. So I mentioned benchmarking back in the beginning of this, and I think it's really important to circle back because we're seeing a lot change in the market right now. And what you're seeing on your screen here is some rates given for treasuries and then what the Maryland LGIP is paying, and of course a sweep account and an interest-bearing checking account. So I use these treasury bill rates just kind of as a baseline. If you go out to market and you see what banks are paying for CDs and what some government agency securities are paying, you might be able to get higher rates. I think treasuries just are a good baseline, a good benchmarking tool for this scenario here. So you see 24-month T-bill, for example, was paying 385 last week when I put this together. And then if we go down to the LGIP, it was at 368. And a sweep account from this one bank was 354. And then I used 175 as kind of an interest-bearing checking rate. just as kind of a market average that we see out there. So a lot of people look at this 385, compare it to what they can get the LGIP, and candidly, it's not that big of a difference. I mean, it's less than 20 basis points that you're going to be picking up by investing out 2 years. And I'm not necessarily here to give you advice on saying you should go invest in that 2-year rate to get the higher yield. But what I can say is that difference may be a lot more than what you think. If we look at the example on the right here, we have $10 million as an example. So we look at 385 versus they use the sweep account rate that you might have at your bank. It's about 31 basis points of a difference. So on the $10 million, of course, it's $31,000. So you do that on $20 million, all right, you just paid for another employee's salary, which is super impactful right now. If we go a step further and look at the interest-bearing checking rate at 175, and I'm sure on this call, there's all sorts of different rates that you all are getting from your banks. Some may be higher than this 175, some may be lower. But using that kind of as an average, this $31,000 goes up significantly. So it may not seem like a lot, if we're talking about $10 million or maybe if you only keep $1 million at your bank. This difference in yield can really add up. And over the last couple of years, we've had kind of the tough situation with rates where these liquid rates have been so high and really few investments out there until recently that have been beating those liquid rates. But there's also an importance to in still keeping your cash invested and protecting yourself against rate volatility. So that's one of the questions I've got a lot recently. Again, why would I invest at 5 basis points lower than what I can get at my local government investment pool and spend all that time moving the funds over to an investment? That's a completely valid concern. It's definitely hard to conceptualize. If I could get 370 at the LGIP, why would I invest for, say, 3.5 in a fixed term investment? Why would I lock up a lower rate? And it's really all centered around that conversation of protecting yourself against rate volatility. And again, while we're not always thinking about, a disaster is going to happen or we're going to have another COVID, it's always good to keep that in the back of your mind. And while maybe you're not getting super aggressive with investing all your cash, you at least have a baseline to protect yourself. So I went back and I looked, of course, 2020 was the easy first example. Rates were at about 2.5% or so. And as we know, pretty much overnight, they went down to zero. So I always say that's the easy example. And we never expect another COVID to happen anytime soon. But that event did happen. If we go back a little bit further, of course, I'm sure a lot of you remember what happened in '08 and the impact that had on rates. It was a bigger drop, and it wasn't necessarily as quick as what happened in COVID, but rates went from about 5.25 down to close to zero very quickly. And when I always bring up these two topics, the feedback I get is, well, the housing crisis and COVID, those things aren't going to happen again. Then if we go back even further to 2001, of course, we had the tech bust, and rates went from about 6.5% down to 1%. So in this case, they didn't go down to zero, but they went down even more than what we saw in '08 and 2020. So over the last 25 years, we saw three of these, I'll call them events, where rates went down fairly suddenly, and those entities that had cash invested at those rates or close to them, all of a sudden they look like geniuses. I can remember the situation in 2020 very clearly. We had entities that were investing at about 2.5%. And when rates went down to zero, of course, no one was earning anything. Some entities missed their budgeted interest earnings. But those entities that had at least some cash invested were pulling in 2.5% for the next 6, 12, 24 months. So in that situation, even though they may have been able to get a little bit more from a liquid product, investing cash turned out to be super helpful. And it really prepared them or protected them against that worst case scenario. So again, these three are very specific events, and we don't expect these events to occur in the future. But if we take it a step further, there may be other things that come up. If it's not COVID, it may be something else that we're not even thinking of today. So I went back as far as this data source would allow me to go back. So it was 1955. So we got about 70 years of history here. And if you look at all of those green translucent lines that go up and down, and as we work our way back, those are all of those what I call the events of rates going down fairly suddenly. So I think is really interesting here is you cannot slice this graph in any 25-year period where three of these events did not happen. So very interesting if we just look at the most recent 25 years, there were three events, and going all the way back 70 years, there wasn't a period where that didn't happen. And all of these have, their specific reasons, and many of these reasons did not overlap. But what that means is potentially we see another one of these in the future. And of course, I don't have a crystal ball, and I'm not here to say we're going to see even more of these events in the future. But history has shown that something usually does pop up every so often. Right now we're in 2026, so a little over 5 years since the last time something like this happened. So again, I'm not making a prediction here, but if history repeats itself, in the next 20 years, three more events would show up. But what I can say is if we start with the left and work our way to the right, the events have a little bit more space in between each, and they're becoming a little bit less common, but they still do happen. And this is all to say that while you don't necessarily have to be super aggressive with your investment strategy, and especially during those times where liquid rates are higher, but at least having a solid amount of cash, that baseline amount of cash that you know is going to be there invested will help protect you against these times and will allow less stress during budget times when you can really rely on an interest earnings number. And what's even more important for that is when you're going through your budget process and budgeting for interest earnings, having cash invested will give you a set amount that you know you can count on. So while rates may not drop to zero, the rate you have in liquid accounts will always fluctuate, and having a certain amount of cash invested in a fixed product will give you that stable number that at the very least you can count on during your budget. I want to shift gears a little bit here to bank specific benchmarking. So all sorts of banks out there in Maryland, we have a lot of banks that want to work with public entities, which is a great problem to have. This, what I'm showing here on the screen is an example of an RFP that I did with the county a couple years back, and they had 5 banks here submit a proposal for their business. And really what this is showing is kind of at the end of the day, the bottom here, the net value received by each bank if they were to switch. If we go all the way to the right here, I'll just quickly explain their current situation. So their current institution, they paid about $127,000 in fees, and they had a DDA rate or interest rate of 3.46% and an earnings credit rate of also 3.46%. One thing that I would always urge people to watch out for is below the ECR here, this FDIC rate, FDIC fee. A lot of banks, especially the big banks, will charge a fee something like this. And it's really a charge that they get from the FDIC for that insurance that they pass on to the client. They can't actually pass on to the client, so they'll change the name, and a lot of banks will call it a balance-based charge or balance-related fee. It's essentially a set basis point fee. So for this institution, it was 17 basis points that's charged for every dollar held on deposit to essentially cover that cost for the bank. So what that does is it effectively reduces that earnings credit rate that they have to offset their fees by that amount. So for this institution, that real value was 3.29%. So doing the math, accounting for the fees and any interest they would earn, they earned about $350,000 at this bank per year. So, I mean, that's great. Being able to work with an institution that provides you all these services and still making $350,000 is incredible. But we're living in a world today where banks are super competitive and there are a lot of options out there. And this RFP was very, very competitive. So these 5 banks responded, and I'll say their current institution was bank 2 here. So even if they wanted to stay with their current bank, they could increase their interest earnings by over $600,000, which is absolutely amazing. So their bank increased that DDA rate to 4.2%, but they actually increased that earnings credit rate. So in this situation, the best structure for them at this institution would be to earn interest on everything and just pay those hard dollar charges so that they can get that higher yield on all their cash. Bank 1 here, this was a different institution that this entity actually ended up switching to. See, their fees were about $52,000, so well over half of what they were coming to from their original arrangement. Also offered that 4.2%, and it generated a little bit over $1 million for this entity. So just night and day from their current arrangement to the new arrangement. And this is not all to say that you should go out and issue an RFP tomorrow to make sure you're getting the best pricing. That's just one of the avenues you can do for bank benchmarking. I always suggest talking to your peers. If you know another finance official at a different entity that works with your same bank, or just an entity that's the same size that works with a different bank, that'll give you a good idea of what banks are willing to pay for different services, what they're willing to pay to offset your fees, or from an interest perspective. Gives you kind of a baseline and information so you can go back to your banking institution and just make sure that you're getting the best deal possible and you're in the most attractive products for your situation and your entity. So taking it a step further, kind of outside the rate and offsetting fee side of things, is really diving deep into those bank fees. And I mentioned before, super important to take a look at all these new services and what fees are being charged. Every bank values these services differently, and for the most part, some of these newer services that are out there, there's a wide level of different charges. One bank may be charging 5 cents for it, another bank may be charging 30 cents. And while that doesn't seem like a lot, with some of the high volumes that go through public entities, it can add up to be a lot of money. So it's important that you're not only benchmarking your interest rates, but also benchmarking these bank fees as well. So taking a step back, looking specifically at the earnings credit rate here, I just kind of have a range of what we've been seeing recently for those earnings credits. So of course we see banks down at the 0.05% range all the way up to 3.5%. There was a time many, many years ago where it was pretty consistent that these earnings credit rates to offset your fees were at about 80% of the Fed funds rate. Nowadays, we see a much wider array, as you can see here, with the average sitting at about 1.6%. So a lot of entities don't like to see bank fees, or maybe your board doesn't like to see bank fees, and that is certainly a valid concern, but it's also important to understand kind of the math behind it. If you can offset fees at, say, 1.6%, but you can earn interest at 3.5%, from a math perspective, it would make more sense to earn interest on every dollar and pay those hard fees so you can net the greater benefit. But that's not always the case. I mean, we go back to COVID, when rates went down to zero overnight. A lot of banks were still offering, a small earnings credit rate. So you may be able to earn, 1 basis point in interest, but maybe you could get 10 or 20 basis points to offset your fees. So this is always an ever-changing conversation, which is why it's important to continuously benchmark this, and you don't just do it once every 10 years. Continuously looking at this is going to be the best way for you to ensure that no matter what the market looks like, you're getting the best arrangement possible for your entity. I think it's also really important to note, kind of taking it a step back and looking at the fees again here, that once we enter the new year, the new calendar year, that's a time where a lot of banks like to look at what they're charging entities for different bank fees. And it's a time where you'll see on your analysis or billing statements a lot of line item fees start to increase. So if you, just as a little helpful hint here, take a look at your December bank fees and then take a look at your January bank fees for this year and compare those unit prices. And you'd be surprised how many banks will increase it by just a few cents. But again, that few cents could mean a huge difference for your bottom line. And lastly here, I just want to talk a little bit about what competitive pricing is, because you'll see from bank to bank, some banks offer super high interest rates, and some banks really rely on providing you the best service available. And every bank prices things very differently. So I just want to kind of touch on some of the things that matter to banks to kind of give you some information when you go into those conversations with your bank so you know what they're looking at from their side. The big one is collateralization costs. As a public entity, banks need to collateralize your deposits, and that comes at a cost to some institutions. And it also depends how they're collateralizing your funds, whether it be a letter of credit or a new way to avoid collateralizing your funds now is insured cash deposit accounts like ICS and CDARS are the big ones. Um, those accounts give FDIC insurance instead of collateralization, and on the back end, they're splitting up your cash into $250,000 deposits that send out to other banks, and those banks send cash back. So you have that FDIC insurance, and there's no need for collateral. That's a newer product that's become really popular lately and has allowed banks to cut some of these costs in collateralization so they can offer better rates in those types of accounts at times. So that's one thing to think of. Relationship is also super important to a lot of banks. If they have a good relationship with you, they're more willing to keep your pricing or your line item fee pricing lower or your interest rate pricing higher for longer. And it also goes along with this hot or stable cash. So when banks talk about hot cash, that's if you send money to them for an investment. So they know, say $5 million for 6 months, I'm going to have that cash for 6 months, and then who knows what will happen. For them, that's hot cash. But if they have your operating business, that's more stable cash, and that's cash that they can rely on because they know you're always going to be paying, making payroll and doing AP runs. So you'll always have some cash in those accounts. So whether it's hot or stable cash could impact the pricing. Um, Usually, I would say that means stable cash gets priced higher, but some banks look for that hot cash as a way to get more stable cash from an entity. And then more on the mechanics side of things, expectations on inflation is a big piece right now. A big topic of conversation lately has been oil prices. All of this is impacting how the bank looks at pricing. Another thing to keep in mind from bank to bank is, are they charging you bank fees or are they under that free checking model? There is certainly a value right now to free checking. If you can do all your services and not have to pay for anything, maybe it makes sense to take a little bit lower of a rate versus paying those fees and getting a little bit higher of a rate. Again, that's why it's important to go through and do the math every so often so you really know what the true value is at each institution. And then, like I mentioned before, those FDIC fees, those kind of hidden costs that aren't always super clear on those statements, those are a few of the things to keep in mind when you're talking to your banks. Okay, I wanted to wrap it up a few minutes early here in case anyone had any questions. But again, really thank you all for having us here today. We're really excited to be more involved in Maryland GFOA. And then me and my colleague Chris will certainly be around at the in-person conferences, but yeah, happy to answer any questions anyone might have.
Okay, certainly appreciate that presentation. Mike and Chris, appreciate your time this morning. We're open for questions if anybody has anything. Don't see anything in the chat, but as Mike mentioned, we have a few events coming up and an opportunity to meet and greet other sponsors, other colleagues. We're going to be trying something new here next month with our spring conference. It'll be a virtual conference via Zoom. Going to break it up into a Thursday afternoon and a Friday morning. So check that out. A good value for the conference there. That's going to be April 23rd and 24th. And then our registration's also open for our annual summer conference, June 10th to the 12th in Ocean City. A great opportunity to network, meet with sponsors, meet with colleagues, and get good education opportunity there. So invite everybody to join us at those sessions coming up as well. With that, cashVest and 3+One again is a sponsor of Maryland GFOA this year, so their information is available on the GFOA website. Feel free to look that over and connect individually and follow up if you want to do a one-on-one. That's fine as well. So with that, I'm going to go ahead and say thank you both for your time, for your sharing with us today. I think it was a very valuable opportunity. So we're going to go ahead and say thank you all. Enjoy this weekend and hopefully gets back to some spring weather here and some Oriole baseball with a good win at opening day yesterday. So again, thank you both. And to everyone who joined, thank you and have a good weekend.
Have a good weekend, everyone. Thank you.
Thank you, everyone. Have a good weekend.